Imagine discovering a wealth-building algorithm so potent, it's deliberately excluded from school curriculums. While ordinary investors chase quarterly returns, billionaires operate on timelines spanning generations. Their secret weapon isn't insider trading or luck. It's a mathematical principle so simple, it's criminal most people ignore it. Warren Buffett turned his initial investment of $10,000 into over $100 billion by mastering one unglamorous. Most people panic sell during crashes, bleeding value. Billionaires reinvest dividends like clockwork, treating market dips as discount seasons. Extend that to 30 years, and you're looking at 10 times growth, without adding a single extra dollar. This isn't speculation, it's arithmetic warfare against inflation and mediocrity. They let time dissolve volatility. Consider this. Selling shares triggers taxable events. Keeping assets untouched allows compounding to snowball exponentially. A $1 million portfolio earning 7% annually becomes $2 million in 10 years. Wait, 20 more, and it's $8 million. But here's where the elite diverge. They use dividends to buy more shares, creating a self-fueling engine. Each payment isn't income. It's a recruit for their wealth army. Patience isn't a virtue here. It's a calculated strategy. The average investor holds stocks for 10 months. Buffett holds forever, while others chase trends. Billionaires exploit the greatest leverage in finance. Decades of uninterrupted growth. You don't need exotic assets. Low-cost index funds mirror this approach. Billionaires automate the process, removing emotion. They don't check prices daily. They let the machine run. But there's a catch. Humans are wired to prioritize immediate rewards. Beating that instinct is how dynasties form. Next time you see a market correction, remember, they're quietly acquiring more shares, knowing time will neutralize the chaos. Your move? Start early. Be consistent. Never interrupt the compounding snowball. One deviation resets the clock. Now, what happens when billionaires store wealth outside traditional markets? While you track stock tickers, they're moving pieces on a global chessboard you never learned existed. Offshore vaults, unregulated assets, and investments immune to economic collapses. These aren't conspiracy theories. They're standard plays in the high-stakes game of capital preservation. And why would someone worth billions intentionally stay in debt? Let's dismantle the next layer. While everyday investors obsess over stock portfolios, billionaires play a different game entirely. Over 40% of their wealth resides in territories you won't find on typical maps, not shady shell companies. Legally recognized jurisdictions like Liechtenstein and Panama, where tax rates hover near zero. These aren't loopholes. They're intentional design features of a system built to protect dynastic wealth. Real estate here isn't about luxury homes. It's about parking capital in assets, immune to political upheaval. Private equity funds act as force fields during market crashes, while public stocks nosedive. These exclusive investments, available only to those injecting a minimum of $250,000, hold steady. They control physical infrastructure, ports, pipelines, data centers. You can't short a shipping terminal. The ultra-wealthy don't diversify across sectors. They monopolize critical supply chain nodes. Art collections and vintage cars aren't trophies. They're stealth financial instruments. A painting worth $20 million isn't just aesthetic. It's collateral for bank loans that never appear on credit reports. Unlike stocks, these assets can't be instantly seized during lawsuits. Auction houses double as clandestine banks, offering liquidity without tax triggers. The rich don't sell their Picassos. They borrow against them at interest rates lower than inflation. Debt is their oxygen. While the middle class fears loans, billionaires engineer debt labyrinths to avoid ever selling appreciated assets. Take a $20 million estate bought decades ago for $1 million. Selling it would incur a $19 million capital gains tax. Instead, they pledge it for a $10 million loan at 2% interest. That cash funds a new apartment complex, generating 15% annual returns. The math is ruthless. Pay 2 to earn 15. This isn't theory. Family offices structure 30-year debt rollovers, ensuring loans outlive their creators. Interest becomes a tax-deductible business expense. The actual asset? It appreciates untaxed, passing to heirs with reset cost bases. The game isn't wealth accumulation. It's perpetual capital preservation. But what about insider advantages no amount of money can buy? While retail investors parse SEC filings, billionaires access intelligence channels closed to the public. Think geopolitical briefings from ex-intelligence agents, or private dinners where central bankers hint at policy shifts 6 months early. How do they turn whispers into windfalls? The answer lies in networks so exclusive, your net worth is just the entry fee. The inner circles of wealth operate on information most never see. Ivy League endowments aren't just school funds, they're early warning systems. Harvard's $16 billion portfolio gets tipped about tech breakthroughs 6 months before IPO filings. How? Their investment managers sit on corporate boards as non-voting observers, catching whispers of patents and mergers. You won't find these opportunities on Robinhood. Private equity isn't about picking stocks. It's about buying entire supply chains. They're restricted to qualified purchasers with over 5 million in liquid assets. The trick? Consortiums pool resources to meet thresholds, creating member-only gateways. Geopolitical intelligence is traded like a currency. Imagine knowing which African nation will legalize rare earth mining next quarter, because your golf partner's firm drafted their legislation. Billionaires don't read news. They fund the studies that become headlines. A $200,000 donation to a think tank unlocks reports predicting regulatory shifts years in advance. Central bank moves seem sudden to the public. But if you're attending Bilderberg meetings or Aspen Institute roundtables, rate hikes are discussed as hypotheticals 18 months prior. The rich don't react to interest change. Family offices employ ex-CIA analysts to map black swan events. One hedge fund avoided the 2008 crash by tracking shipping container cancellations in Guangdong 6 months before Lehman fell. Public data exists, but connecting dots requires teams of 10 full-time researchers. Here's the unsettling truth. Markets aren't efficient. They're staggered information. By the time retail investors act, institutional players have already priced in the move. The solution: stop chasing hot tips. Study sectors so thoroughly you anticipate layer 2 effects. If electric cars boom, who supplies their lithium? Billionaires don't invest in trends. They own the infrastructure beneath them. But knowledge alone isn't enough. The ultra-wealthy engineer ecosystems where every asset protects another. A copper mine in Chile isn't just a revenue stream. It's collateral for a loan to buy a German battery factory. Each move reinforces the next, creating a fortress of interdependencies. Now, what happens when these strategies collide with government regulations? Laws evolve to reclaim leaked advantages, but wealth's architects stay 3 steps ahead. The final piece isn't about growing fortune. It's about making it bulletproof across generations. The key lies in structuring assets across jurisdictions with conflicting laws. A trust in the Cayman Islands owns a foundation in Liechtenstein, which controls a company in Singapore, a legal maze no single nation can fully unravel. These structures aren't about evasion. They exploit gaps between sovereign legal systems, creating firewalls against seizure or taxation. Dynastic planning starts at birth. A billionaire's child inherits non-voting shares in a Bermuda entity, receiving dividends without ownership risks. The actual voting rights, held by a protectorate in Luxembourg, staffed by attorneys bound by client-attorney privilege. This isn't inheritance. It's financial teleportation. Assets skip probate, creditors, and public records. Philanthropy serves dual purposes. Donating appreciated stock to a private foundation avoids capital gains tax and deducts the full market value. The foundation then sells the stock tax-free, funding ventures that boost the donor's other businesses. A $5 million donation could yield $20 million in indirect benefits. Charity becomes a strategic lever, not altruism. When political winds shift, the wealthy activate residency by investment programs. A €500,000 investment in Greek real estate grants EU access. Barbados offers visa-free entry to over 100 countries for those parking $2 million in government bonds. Mobility isn't a luxury, it's an insurance policy against regime changes. But the ultimate shield is influence. Lobbying firms draft legislation with loopholes tailored to clients. A single clause in a 1,000-page infrastructure bill could exempt certain trust structures from reporting requirements. These adjustments aren't publicized. They're buried in legal jargon, unnoticed until exploited. Asset protection isn't reactive, it's preemptive. Art collections undergo fractional ownership, restructuring. 10 investors each own 10% of a painting through an LLC, diluting liability. Sue one, and you're battling 9 deep-pocketed co-owners. Yet none of this matters without succession engineering. Family constitutions mandate mandatory arbitration, preventing heirs from litigating against each other. Offspring who refuse to sign forfeit their stakes. Governance becomes a non-negotiable protocol, enforced by third-party enforcers. The lesson: wealth preservation isn't a product. It's an ongoing siege against entropy. Every law passed, every market shift, demands adaptive countermeasures. The wealthy don't defend their castles. They build moats that evolve. Now, As retail investors gain access to once exclusive tools, the game's rules are mutating. Will these strategies remain effective, or will new loopholes emerge? The final answer determines whether today's fortunes become tomorrow's footnotes, or eternal dynasties. The billionaire playbook isn't about secrets, it's about systems. The wealthy engineer self-sustaining ecosystems where each component reinforces another. Tax-optimized jurisdictions shield assets. Debt structures fund cash-flowing ventures. Insider networks provide asymmetric intel. Together these form an unassailable fortress. But the blueprint is crumbling. Regulators now target offshore trusts, demanding transparency. This creates both peril and opportunity. Replicating these methods requires no seed capital, just cognitive rewiring. Start by auditing your portfolio's weakest link. Is it vulnerable to inflation, litigation, currency crashes? Treat each vulnerability as a puzzle to outsource or neutralize. Geopolitical hedging isn't reserved for oil barons. Diversifying assets across politically stable regions can mean splitting savings between Swiss francs and Singaporean real estate investment trusts. Even modest portfolios benefit from jurisdictional arbitrage. Some European banks offer multi-currency accounts to non-residents with minimal deposits. Time remains the ultimate unfair advantage. A 25-year-old investing $300 monthly at 7% annual growth amasses over $600,000 by 65. Wait until 35 to start, and you'll barely clear half that. The difference? 10 years of compounding. A gap no stock pick can bridge. Billionaires grasp this math instinctively. They front-load sacrifices to backload freedom. Legacy building hinges on minimizing decision fatigue. Automate contributions to low-fee index funds. Schedule quarterly reviews to rebalance allocations. Delete trading apps. Wealth grows fastest when untethered from emotion. The richest families operate on autopilot. Their money working while they sleep, vacation, or pivot to new ventures. But here's the twist. These strategies are evolving faster than textbooks can record. Staggered ownership models, decentralized autonomous organizations, and AI-driven tax optimizers are reshaping the landscape. What worked for Buffett may falter in an era of quantum computing and central bank digital currencies. Adaptability is the new core skill. Your takeaway? Stop searching for the next big thing. Master foundational principles, compounding, diversification, leverage. Then layer in modern tactics. Study blockchain's role in asset tokenization. Explore how climate policies will reshape commodity markets. Knowledge compounds faster than capital. This isn't financial advice. It's a reality check. Fortunes aren't built through singular genius. They're sculpted through decades of disciplined system adherence. Whether you manage $1,000 or $1 billion, the rules remain constant. Time magnifies wise choices and erodes mistakes. The question isn't whether these strategies work, it's whether you'll implement them before the window closes. Share this with someone ready to escape the hamster wheel. The clock's ticking.